In June 2020, auditors at Ernst & Young made a phone call that would destroy one of Europe's most powerful companies. They called two banks in the Philippines. They asked one simple question: can you confirm you're holding 1.9 billion euros for Wirecard? The answer came back quickly. No. Not we can't confirm. Not we'll check. Just no. Germany's most celebrated tech company, valued at $20 billion, had invented nearly 2 billion euros out of thin air. Within days, executives were arrested. Investors lost everything. And one man vanished, never to be seen again. This is the story of Wirecard. Wirecard wasn't just a company. It was Germany's tech champion. For years, Europe had watched Silicon Valley dominate payments. PayPal, Stripe, Square. Wirecard was supposed to be the answer. A homegrown fintech success. A symbol that Germany could innovate. In 2018, Wirecard replaced Commerzbank, a 150-year-old institution, in the prestigious DAX index. It was now worth more than Deutsche Bank. Politicians praised it, regulators defended it, investors trusted it, and all of it was fake. Wirecard was founded in 1999 as a small payments processor, but the transformation began in 2002 when Markus Braun became CEO. Braun was charismatic, disciplined, obsessed with control. He styled himself as a European Steve Jobs, futuristic language, bold promises. Under Braun, Wirecard grew aggressively. Acquisitions across Asia, expansion into high-risk markets, claims of massive profits year after year. The business model sounded complex, but impressive. Third-party payment processors, cross-border transactions, emerging markets. Most investors didn't understand it, which made them trust it even more. Wirecard's numbers were strange. It claimed huge profits from regions where it had no physical offices, employees barely existed, partners were unknown. Much of its revenue supposedly came from third-party partners, companies Wirecard did not fully own, audit, or control. This should have raised alarms. Instead, it raised the stock price, because Wirecard delivered one thing investors loved: consistent growth. Every year. No matter the market, no matter the economy. Too perfect. In 2015, reporters at the Financial Times noticed irregularities. They began publishing investigations under a series titled House of Wirecard. They uncovered fake invoices, inflated revenue, dubious partners in Singapore and Dubai. Internal whistleblowers. Wirecard's response was aggressive. They sued journalists, hired private investigators, claimed a global conspiracy by short sellers. And then, something unprecedented happened. Germany's financial regulator, BaFin, did not investigate Wirecard. They investigated the journalists. For the first time in history, Germany banned short selling of a single stock, Wirecard. The message was clear. Wirecard was protected. Behind the scenes was Jan Marsalek, Wirecard's COO. Marsalek was brilliant, shadowy, dangerously confident. He handled Wirecard's most complex operations, especially in Asia. Colleagues later said he avoided scrutiny, controlled information, ran side operations nobody understood. He claimed connections to intelligence agencies, talked about classified projects, and moved freely through risky jurisdictions. Marsalek was not just lying, he was running the lie. By 2019, pressure was mounting. Auditors at EY demanded proof of Wirecard's cash, especially 1.9 billion euros held in trust accounts. Wirecard provided documents, bank confirmations, letters, signatures. Everything looked official, until EY contacted the banks directly. Both banks replied, the accounts did not exist, the documents were forged, the signatures were fake. At that moment, Wirecard collapsed. The foundation was gone. June 2020, Wirecard filed for insolvency. Its stock crashed from €104 to €1.28. Markus Braun was arrested, and Jan Marsalek boarded a plane. He disappeared. Investigators believe he fled via Belarus, possibly protected by Russian intelligence contacts, possibly living in Moscow. To this day, he remains one of Europe's most wanted fugitives. The fallout was enormous. Investors lost billions. Employees lost jobs. EY faced lawsuits. Regulators admitted failure. Wirecard wasn't just a fraud. It was an institutional collapse. Auditors trusted documents. Regulators trusted reputation. Investors trusted confidence. Everyone ignored the simplest question: where is the money? Wirecard teaches us something uncomfortable. Fraud doesn't survive because it's clever. It survives because people want to believe. And when belief replaces verification, even a 20 billion euro lie can look real.